Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you who are joining me here on the East Coast. I want to say good morning to those of you who are joining us from the Central Time Zones, the Mountain Time Zones, or the Pacific Time Zones. And of course, good evening for any of you who are joining us from across the pond in parts of UK or parts of Europe. Welcome to today's presentation, Bulletproofing with a Riskless Spread Trade. Today we're going to show a riskless spread trade in the context of a radioactive position, how that bulletproofs the position where you have no risk and still we can keep infinite potential profit to the upside, a perfect place to be, of course, as we head into earnings season across the market. Well, for those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options. I've been trading radioactively and working side by side with Kurt Frankenberg for the past 8 years. During that time, the radioactive position, the radioactive trading technique has represented about 50 to 60% of my trading portfolio. I have been trading options for about 15 years. And the reason why that I still allocate a large portion of my portfolio to radioactive trading is because over time, it is the most consistent strategy that I've seen to actually meet my potential goals, my trading plan, and to see consistent returns. Okay, I do also support one of the accounts in Fusion. Fusion, of course, is the subscription service at RadioActive Trading designed to help investors master the details in the blueprint as well as see how we trade these techniques in our personal account. Myself, Ernie Zarrenner, the president and founder of Power Options, and Greg Zarrenner all show our actual trades radioactively at the Fusion subscription. In addition to that, you can also see all of our track records as well as Kurt's track record, who founded the radioactive trading techniques. Now, what we're going to cover today is spend a brief moment just looking at what is a radioactive trade, the initial setup that we use to limit our risk and leave our upside open. We're going to talk about credit spreads. We're going to talk about the benefits and risks of a standard credit spreads, how to solve the problems with standard credit spreads. We're going to look at an actual trade that's bulletproof right now using a riskless spread trade done in the proper context as well. So that's what we're going to cover today. Now, many of you have seen this before. The initial setup of a radioactive profit machine consists of buying stock, and at the same time, we're going to buy a put option against that position based on the guidelines in the blueprint, which describes the initial setup and all of the 12 different income methods that we use to adjust the position. Now, the put option acts as insurance. When we buy the put, we have a guaranteed exit for our stock position, so we know going in exactly what our risk is, even in the worst case scenario. However, it's not just insurance. It is a second asset that can be manipulated to lower the risk on the position, lower the cost basis into the entire position, or to profit in either direction. We're going to see that as well. Now, we're going to take a look at FootLocker today. We're going to show different trades on FootLocker. But if I was going to open a radioactive position on FootLocker, I currently have one open. We'll see that at the end of the presentation. But if I was going to get into FootLocker today radioactively, I'd buy shares of FootLocker at around 58.50, 58.55. At the same time, I'd buy a January put that's about 180 days out in time for $5.50. The 60 strike put right now, slightly in the money, is trading at $5.50. Now, out of pocket, I would invest $64.05 per share. But remember, the put option means that I can force someone to buy my shares of stock at $60 at any time. If the stock falls to $2 per share tomorrow for any unexpected event, I'm still guaranteed to get $60 back. So the most I'm risking on this position is $4.05, or 6.3% of what I invested in the position. Now, it's also important to note that if I'm trading, let's say, an account with roughly $40,000 and I allocate $6,400 of that to enter this position, well, if I'm only risking $405, that means the monetary risk is less than 1% of my total portfolio value. So even if I did take that maximum risk in the worst case scenario, I'm only losing 1% of my total portfolio value. Okay, that's what we call proper position sizing. Whoa, I'm sorry, that shouldn't be there. Sorry about that. All right, now let's take a look here This is the profit and loss chart of our radioactive position. Now, as I mentioned, if the stock stays below $60 per share, we'll have the loss of $4.05. But in order for that to happen, I would have to hold the position all the way to January expiration, and the stock would need to be trading below $60. I can't control where the stock's going to be trading, but I'm not likely to hold this position all the way to January expiration without making any adjustments. Notice the curved red line here showing us the profit and loss chart at the halfway point. And even though that we invested $64.05, on October 21st, the stock's trading around that range, we'll be at a profit. This is because we're not down $4.05 as soon as we open the position. We're not $4.05 behind the 8 ball, so to speak. In fact, all we're risking when we open the position is the bid-ask spread. The initial setup follows the 3 core principles we talk about radioactive trading, but it's really the 3 core principles of any option strategy. Number 1, when we open the married put position, the radioactive trade, we're forced into an ideal size trade. Yes, I might have invested $6,400 into this position, but because of the structure of the trade, I know I'm only risking 6% of what I invested, even in the worst case scenario. And I also know that I'm only going to risk about 1%, 1.5% of my total portfolio value in any one position. When we talk about the at-the-money bell curve, and the at-the-money bell curve, those of you who trade, of course, and we'll find that out in a minute, shows us that options that are in the money or out of the money have a lower time value. It's better to buy options that are in the money and out of the money so that you don't pay as much in the time premium. But when we're selling, we want to sell at the money. Now, that example I showed is a little bit in the money. It was a 60 strike put. We could get only a 4% risk if I bought the 62.5 strike put. But in this case, the 57.5 would have been at the money. The 60 is a little bit in the money. So that risk we have of 405, that's just the time value premium. And of course, the red line, or the time decay line. And what that shows us is that if we open a position that's 6 months, 7 months out of time when we're buying, we see a very slow time decay to about the 3-month range and even about the 2-month range. But when we get to those last 45 days and the last 30 days, that's where we see the rapid time decay. So we want to sell here, and we want to buy further out in time to give us a lower cost per day, a lower annualized cost. We want to sell near term to get a higher annualized cost. But if you think about it, these 3 core principles apply to any option strategy, whether you're trading covered calls. You want to make sure that you're not trading too much in any one position. You're likely selling closer to at the money to get the best time value, and you're probably selling shorter term, maybe even weeklies or monthly, to get the best annualized cost. Those of you doing credit spreads are likely doing the same thing. You're trying to position yourself where you know the maximum risk, but at the same time, you're not over trading. You're going out of the money because you want the better probability, but you're still probably selling shorter term as well. All right, now back to that original position, how we open a radioactive trade. If I open that position today, I could immediately sell the stock at about $58.50, and I could sell to close the put for about $5.30. All I'm risking is the bid-ask spread when I originally open a radioactive trade. Now, of course, we're going to suffer some time value decay on the put that we bought. We expect that. That's why we have the different income methods to completely position ourselves to counter that loss in the time value and potentially bulletproof the trade. Now, let's take a look at what this radioactive trade would look like in 30 days, or perhaps the effect of earnings coming up on August 19th. So here we've got that same screenshot, the same profit and loss chart of the initial radioactive position. But we're looking at it on August 19th. What would the theoretical value of our position be? Well, as I mentioned, I put in $58.50, so we're down 5 cents, $5 from where we bought it on the stock. And at the same time, we would expect some time decay on the position. But again, if we did nothing to August 19th, and the position stayed, the stock stayed at $58.50, I could sell the stock at $58.50. We'd see maybe 70 cents of time decay loss on our put option, So I'd have a loss of only $74 on the position, which is only, let's say, about 1/5 or 1/6 of the maximum loss we could take on the position. But look at the curved red line. This shows the profit and loss chart of our position on August 19th. And as we see, if the stock's trading at $60, theoretically, we would have no gain or no loss. But we're not near the break-even point of 64.05. Yes, I still have 64.05 invested into the position, but because the put's not decaying 1-to-1, and because we're not $4 behind the 8 ball, we could still see a profit. And if the stock had moved up to 64.05 or break even on or around August 19th, we'd probably have a profit of maybe $200 or so, because the put does not decay 1-to-1 with the stock. It's actually an asset that we can use to manipulate. Now, if the stock was trading at 66, you see we have a nice profit. Why am I showing that? Well, if earnings come out around August 19th and the stock, let's say, moves up 2 or 3 points, only a 5 or 6% move, we'd have a large profit on the position. Okay, we're just above the break even, but because the put didn't go to zero and we haven't lost all of the intrinsic value, we still have a lot of time value remaining. We'd be at a reasonable profit. All right, so for those of you that are new, that's just a review of why we trade radioactively. We stack the market odds on our favor. We've got a limited risk position, but we're not down the cost of the insurance when we open the position. We don't have to feel the need to immediately make up that risk of 405 or the cost of 550 for the put, because we're still going to have a lot of time value remaining on the position. Now, before we go any further, I just have 2 quick polls for you today. We're just going to launch those right now. What we'd like to know is, what kind of option strategies are you trading right now? Are you mainly looking at covered calls and naked puts? Are you looking at buying calls and buying puts, straddles or strangles? Are you focusing on the credit spreads and debit spreads? That might include iron condors as well, any of the vertical spreads. Are you using some of the protective strategies? By that we mean the radioactive techniques already, or maybe you're using standard collar positions. Or are you currently trading calendar spreads, either horizontal spreads or diagonal spreads, maybe even double diagonals as well? So I've had the poll open for about 45 seconds. I'm going to leave it open for a full minute. If you haven't voted yet, I encourage you to do so. All right, so I'm going to leave it open for another 10 seconds. We've got more than 50% of our audience voting, and more votes are still coming in. Okay, fantastic. Let's go ahead and close the poll. Yeah, a couple more votes coming in. I'm going to go ahead and close the poll, and we'll share the results with everyone. So right now, 35% of you are doing, of course, covered call positions, naked puts. 45% of you are doing call buying. Maybe you're doing straddles or strangles around earnings. We'll probably have a webinar at Power Options tomorrow regarding the earnings for using straddles and strangles for earnings. 75% of you are doing credit spreads, which makes sense based on the title of this presentation here. 45% of you are using radioactive trades or protected positions, and of course 45% of you are using calendar spreads as well. Now, one last quick poll here. Just want to know, how's that working out for you? With the time, with the strategies that you've been trading, are you having more winners than losers and you're ahead of the game, you're making profits? You feel that you're winning some, you're losing some, but you're not quite seeing the overall returns in the portfolio that you want? Have you won more than you lost? You have more winners than losers, but you're losing money. Or are you unfortunately not doing too well? You're losing more than you're winning, and you're way behind. Don't worry, this is completely anonymous. Okay, so we just want to get a gauge here of what we're looking at and how things have been working out for you, and maybe how, of course, we're going to be able to improve them. All right, so I'm going to leave the poll open for about another 10-15 seconds here. Okay, this started to switch a little bit, and I'm not liking what I'm seeing, but unfortunately, we know that's how that's going to happen. All right. So let me go ahead and close that. Now I want to share the results with everyone. Fantastic. 20% of you, 19%, are doing great. You've got more winners and losers. You're ahead of the game, and you're doing well. That's great to see. Close to 70% of you are in the meh range. We're winning some, we're losing some. We're not seeing the returns that we want. Okay? That's about 67% of you. 5% of us are seeing more winners than losers, but we're still losing money. We're going to show you why in just a minute. And of course, unfortunately, this is what I did not want to see. 10% of you are doing terrible. You're losing more than winning, and you're way behind. That's not what we want to see. We're going to try to correct that as well. All right, so let's go ahead and hide those results there. I'll make sure the screen comes back up where we want to be, ladies and gentlemen. Fantastic. All right, so why am I picking on spread trades today? Well, 75% of the audience is doing spread trades, and we saw about 70% of us are win some, lose some, not seeing the returns that we want, and another 15% of us are losing money. 5% are losing money, winning more than they're losing, and 10% are doing terrible. 20% of you are doing great, roughly, so that's still fantastic to see. But credit spreads and debit spreads, let's be honest, they are attractive. The allure of a credit spread, we generate income up front. We see premium coming into our account. It's nice to see our account value go up right away when we enter the trade. We can put up as little as 1/10 to 1/20th of what we'd pay to get into the stock for a covered call, for a collar, a cash secured naked put, or a married put. It's very attractive. We're using leverage in our favor. We know the risk going in. We can look at the position and say, okay, I'm going to open a 5-point spread. I'm going to generate 50 cents of net credit. So that means I'm looking at a leveraged 11% return, and I know that the worst I could lose is $4.50. And at the same time, we can find those type of credit spreads with a high probability, a 75, 80, or 85% of expiring worthless, and we can even do this on a weekly basis. It sounds fantastic. It sounds sexy. It sounds very attractive. But the dark side of credit spreads, debit spreads, any leverage position, the leverage gains also mean you're going to suffer or have the potential to suffer leveraged losses. I just mentioned a quick spread there that where it might make 50 cents on a 5-point risk. So we're looking to make 50 cents on a margin requirement of $4.50. Okay? Well, that also means about a 9-to-1 or 10-to-1 risk-reward ratio. One loss for any unexpected event that we couldn't plan for, we couldn't see in the news, you couldn't see in the fundamentals or the technicals of the position, could wipe out 10 previous trades. This is where some of you are falling into that category where you might have won more than lost, but you're still losing money. Discipline is required to avoid overtrading. We talked about how I might open a married put today on Foot Locker and have an investment of $6,400. And you might take a look and say, well, I'm bullish on Foot Locker maybe. Mike's opening a married put. He's obviously bullish. I might be bullish and I might open a bull put credit spread. But would you, on a 2.5-point spread or a 5-point spread, do 10 or 15 contracts on a 5-point spread to invest the same $6,400 I'm investing? Not likely. You probably only invest maybe $2,000, $2,500, maybe only open 5 contracts, depending on your risk-reward tolerance and what your trading plan is. Any unexpected move, not even dropping below the strike prices of a bull put or rising above the strike prices in a bear call, can quickly result in a 20, 30, 50, even a 100% loss on your position. And again, you take a 100% loss on a credit spread, we know that means you're going to wipe out 5, 10, maybe even 15 gains from previous trades. All right, so let's talk about what we might look at entering a popular bull put credit spread strategy on Foot Locker today. This is not a recommendation or suggestion. Earnings are coming up before the expiration date on August 19th. So this is probably not a strategy that you want in earnings. We're going to take a look at why, of course. But if stock Foot Locker is trading at 58.55, we could open a bull put credit spread today by selling the August 55 put for about 75 cents. This is about at 10:30, 11 o'clock this morning. I could also buy to open an August 52.50 put. So now I don't have a cash secured naked put at 75 cents. We've changed the dynamic. We paid 35 cents. We're still going to take in a credit of 40 cents. But I've got to cover the difference in strike prices. my broker would require me to put up $250 per contract. So if I did 2 contracts, I might have to put up $500 for the trade, and we'd take in 80 against the $500 margin. But most brokers are only going to charge you the difference in strike prices minus the net credit, so we'd have a margin of 210. So I'm risking 210 to potentially make 40 cents. This does offer a 19% return. If Foot Locker stays above 55, both puts expire worthless at expiration. We keep the 40 cents. That'd be a 19% leveraged return. And the theoretical probability right now that Foot Locker was going to remain above 55 at August expiration would be about 77%. So that's a good probability. Maybe not the best. I know some of you look for 80 or 85% probability, but we've got a strong probability of making a 19% return in about a 29, 30-day trade. Okay, well, here's our profit and loss chart for the position. Again, if the stock stays above 55, both puts expire worthless, we keep our 40 cents or $40 for one contract for risking 210. But with earnings coming up just before August 19th expiration, if the stock gaps down and falls to $53 or $54 per share, we're going to be looking at a 70 or 80% loss. We'll lose maybe $1.80, and if it drops below 52.5, we'll lose the full 210. So what does that give us? It gives us a high probability trade, 77%. All right. We have a leverage return of 19%. We get our credit up front. Sexy. It's an attractive trade. But looking to make 40 cents and risking 210 is just over a 5-to-1 risk-reward ratio. We suffer the chance, we suffer the risk of potentially losing 100% of whatever I invested in the position. The leverage spread trade does not force you into an ideal size trade. You have to be disciplined to make sure whatever you're risking monetarily, let's say we did 2 contracts, we take in $80, still a 19% return, against a risk of $420. Again, if I'm in a $40,000 account, I want to make sure that the most I could lose on this position is probably no more than 1 or 2% of my total portfolio value. Okay? But that setup we just looked at, is this a trade for earnings? Well, if it gaps up, sure. But if it gaps up a lot, goes to 65 or 66, we can't make any more than that $40. And if it gaps down because of poor earnings or an unexpected event, we could suffer a 5-to-1 risk-reward ratio. We could lose 100% of what we invested in the position. This is the dark side of credit spreads. So how can we solve this problem? Can you look for a higher probability? Well, sure. We showed a bull put of selling a 55 and buying the 52.5. You could sell the 52.5 and buy the 50. That would only give you about 10 cents, 15 cents of net credit, which would be closer to an 85% probability, which means you need to be right more often than wrong, more so, in order to profit. Could we go for a higher net credit? Sure. We could sell the 57.5 and buy the 55, get a higher net credit. It would have a lower margin, but now we'd have a smaller probability. What about wider strikes? Going to a 5-point strike difference or a 7.5. We'd get a higher net credit, but now you have to put up more money in the position. Let's see what's possible. Let's answer the problems we're suffering, 75% of you who are talking about credit spreads and even other strategies where you're winning some, you're losing some, but you're not seeing the returns that you want. Especially the 5% who are winning more than you're losing, but you're still losing money. And of course, the 10% of you that are doing terrible. What we're going to do now is I'm just going to quickly navigate over to RadioActive Trading. There we go. Make sure that comes up. All right, and we're going to take a look at the Resources tab of RadioActive Trading. We're going to go into the Trade Simulator tool. And what this tool is going to do is we're going to put in our expected target return percent, the max loss that we'd be willing to take on a position or a strategy. We're going to control our investment amount, and we're going to set our probability of loss. So let's take a look at our potential Foot Locker credit spread. Remember, we were looking at a potential 19% profit. We're going to make 40 cents off a risk of 210. Now, we know that we could lose 100% on the position. which was 210, right? But most of us trading credit spreads aren't going to allow that to happen. If the stock suddenly falls, we're going to try to make an adjustment. Where are we going to adjust it? Well, we're probably going to look to adjust the position. Maybe if we see a 3 times, if the debit to close the position is 3 times the initial net credit, $1.20, which was 50% roughly of the loss we could take. Okay, so we're going to put in a loss limit of 50%. But remember, we had a 77% probability. So let's set our probability of loss 25%. Let's just say we took $10,000 and we invested $5,000 in each trade. So it'd be about 15 contracts. We could lower that too. But let's just take a look here. What could we expect? What the tool is going to do is flip a coin 100 times. Heads we win, tails we lose. We're going to look to win 75% of the time. When we're right, we make 19%. And when we're wrong, we're only going to lose $1.05 or $1.10, half of the maximum risk we were taking on that credit spread. Look at that. 74% of the time we were right, and 26% of the time we're wrong. But over the course of 100 trades, we're down almost 55% of our total portfolio value. Because the losers, you can see that here, right away off the bat, we're down 7,500. We get that back, we take it back up to about 10,000 after strings of winners and losers, but again, we could be right more often than wrong and still lose money. Let's try to be right more often. Okay, here we're bankrupt after 34 trades, and we even had 5 winners in a row and took our accounts up to $15,000 in this simulation. But over time, we went bankrupt very quickly. Okay, all right, here's what I wanted to show you. Remember our probability for that bull put spread was at 78%. Okay, here, well, 77, but let's call it 78%. Here we're right 78% of the time, have 22% losers, and we potentially doubled our money. But before we doubled the money, remember we started off with $10,000, before we doubled our money, we were down 58%. How many of you honestly, I don't have a poll for this, but how many of you honestly would stay in a strategy long term once you saw your portfolio value or the money that you allocated to that strategy was down more than 55%? I know I would have stopped. I wouldn't have continued on. This does show that we could be successful long term, keeping this win-loss ratio, but the drawdown is a killer, isn't it? Okay? So here, of course, same thing. Now, how can we control this? Well, let's say we're right more often than wrong. We're going to look for those spreads that have a better probability, closer to that 80%, 85% probability. We're going to take this down to 20% probability of loss. But remember, if we're looking at that, the 20% probability of loss, we also know we're probably going to be in that 80, 85% probability. Our returns are going to be closer to that 11% gain. Remember, making 50 cents off of a 5-point spread. So again, let's say that we do take 50 cents off of a 5-point spread. We've got a 9-to-1 risk-reward ratio, but we're going to be right 80% of the time now. How is that going to work out for us? Well, here's 80-20. At one point, we brought the account up 20% from where we started, but we can still end up 78% down. Okay, we got to be right more often than wrong. Let's find a good one here. Try to get it up to 85, 82. All right. Let's change the probability. Let's say you did have an 85% probability, so your probability of loss is only 15%. Here you go. 88 winners, only 12 losses after 100 trades, and you've got a very successful track record. There's 77 again. But look at this. Being right 83% of the time, looking to make 11% when you're right, trying to control that 5-point risk to get out at a $2 or $2.50 loss, 50% of the maximum risk on the position, and you need to be right 83% of the time. You were right 83% of the time, and you're still losing money. This is why those of you said you're winning more than you're losing, you have more winners than losers, but you're still losing money. It's the structure of the credit spread that can get you. Leverage profits also mean high leverage losses. Looking for the higher probability means you do have to be right more often than wrong in order to profit long term. And that's the danger. That's the trouble. As sexy as credit spreads sound, that's the problem that we run into. All right. Now, so we already talked about how do we solve the problem? Well, you can try to adjust the probability. You can try to adjust the strike differences. You can try to go to wider strikes, but you're still going to have many more winners and losers. If you have a probability of 80%, you're likely going to have to be right 84 or 85% of the time. If I have a probability of 75%, that still dictates I need to be right more than that. I need to be right 80% of the time in order to profit long term, even if I'm not allowing myself to take 100% loss on a credit spread, which we all know we can't do. I can't control that. If the stock gaps down for an unexpected event and I suffer the 100% loss, that is outside of my control. So how do we stack the market odds in our favor? How can we properly control risk to single digits and maybe still take advantage of spread trades? Well, let's look at that RadioActive Trade once more. Again, we could buy 100 shares of Foot Locker at $58.55 roughly, buy the January 60 put at $5.50. We would invest $64.05. We'd have a guaranteed exit at 60, but my total risk would be $4.05. Okay, so still about a 5-point spread if I took a 95-cent net credit. But remember, I'm risking $4.05 of an investment of $64.05. Only 6.3%. I'm stacking the market odds in my favor. Now let's consider a bear call spread. The opposite of what we just focused on with the bull put. Here we're going to sell an at or out of the money call above the current stock price and buy a higher strike call. And if the stock stays below both strike prices, the calls expire worthless and we keep the net credit. Well, here's a favorable spread with Foot Locker at $58.55. We're going closer to at the money. So I could sell an August 60 call at $143, and I could buy an August 65 call for 25 cents. So my total net credit would be $1.18 on a 5-point spread. That's a $3.82 margin requirement at my broker. This is a 30.9% return, but it's only a 60.6% probability because I'm using right at the money strike. Okay. Now, here again is that profit and loss chart. Again, we're looking at a high net credit of $1.18 off of a 5-point spread, so we're only risking $3.82. This is a 3-to-1 risk-reward ratio roughly. So we got a 30.9% potential return. But again, we only had a 60% probability. Would this work better? Let's go back very quickly. Just run that scenario. Okay. All right, so now we'll put in our numbers here. Let's call it a 31% target return. And I'm risking $3.82, but again, I might try to close it if we get to that 50% loss, meaning just half of the $3.82. And again, my probability, though, it's closer to about 40%. So we're taking in almost double the return, still trying to control our risk, but we've lowered our probability. All right, so here, if we do have 70% winners, we're going to have a very profitable position, okay? But again, we had a 60% probability of success, even if I'm right 66% of the time. With a higher net credit and lower probability, we're losing money. We got to be closer to 70%. And we can, of course, go bankrupt very quickly, even with a 30% winner, based on how many we win. So there's one that's 72%. So if we open positions that have this high net credit, but only a 60% probability of success, and we outpace ourselves, we'll look really, really good, won't we? Okay? But this is why it's deceiving. If you open a credit spread with a 75% probability, you probably need to be right 80% of the time to profit long term. If I open a position with a high net credit and only a 60% probability, I'm going to need to be right 67, 68% of the time in order to profit long term. Okay? And then, of course, we can go bankrupt very quickly depending on the losses and how soon those losses pile up on our position. All right? This is the dark side that we talked about with our credit spread positions. Oh, one second here. All right. Now, let's take the two together. All right, we know we had a risk of 382 on our bear call spread. We looked at Foot Locker, we have a risk of 405. So what if we add the bear call spread we just saw on Foot Locker to the existing position? The original maximum risk on the RadioActive Trade was 405, 6.3%. If we add the bear call, which carried a income of 118, but a risk of 382, we add that on top of our protected position, our risk drops to only 287, or 4.6%. Why does it not go up to 782? Because we're doing the nested spread trade. We're taking advantage of the credit, but we're not adding any risk. And we give ourselves a little heartbeat here. Our risk to the downside is reduced by that $1.18, but we don't have to worry about this margin requirement in the middle. Why? I own stock already. I bought a put that protected it to a single-digit at-risk amount. When I add the bear call spread on top of it, the obligation between the two strikes is covered by the stock. I don't have to put up the $2.10. I don't add to the risk. In fact, we take away from the risk of the entire position. We still generate the credit in, and if the stock gaps up to 66, 67, or 68 with earnings coming up, we still have infinite upside profit potential. We've got a better structure now. We've got the risk reduced to about 287. We didn't take it down by half, but we've greatly reduced the risk. If the stock stays where we want, below 60, we can do that spread again and further reduce the downside risk as well. This is one of the 12 income methods that we use in radioactive trading as described in the blueprint to reduce the risk on our radioactive trade, leave the upside open. Risk is not added to the position. We are in a riskless spread trade in the proper context of limited risk. Now, we talked about bulletproofing in the email. What about bulletproofing? What does that mean? Well, the original radioactive trade for Foot Locker was opened on May 5th, 2016, and earnings were coming up on May 20th. Fusion subscribers saw that we opened this position using what we call income method number 12. We bought Foot Locker at $60.60 on May 5th. We bought a January 62.5 put that was roughly about 250 days out in time, and we also bought a June 62.5 put, giving us sort of a synthetic straddle, or strangle I should say. Oh, straddle, I was right the first time, I'm sorry. A synthetic straddle on the position with earnings coming up in 15 days. That's another way that we can do this. Well, earnings came out May 20th. Foot Locker dropped about 7% at the open, and it dropped down to about $55 per share. It's trading around $55, $54.90 at the open. Remember, our cost basis was $60.60, but that was no problem. What we were able to do with the radioactive techniques, of course, is manipulate the position. We took a $4 profit on our June put to lower the cost basis. We adjusted the January put using a different income method, which also reduced our cost in the position by another $4, and then we sold a call for 70 cents. It was the 57.50 with implied volatility, so we got another 70 cents in to further reduce it. Later in July, we used another adjustment on the position. So, as of 2 days ago, July 18th, Foot Locker's trading at $58.57. It's $2 below my cost basis that I entered the position of $60.60. But because of the application of the different income methods from May 5th to July 18th, we'd lower our cost per share on the stock to $55.02. We are now holding a November 60 put, some of the adjustments that I mentioned, that we paid $5.10. So our now total invested into the Foot Locker position after 3 adjustments is $60.12. We're holding a November 60 put, which means we're only risking 12 cents or 0.3% on our position. Earnings are coming up on or around August 19th. And how would this look now if we took that income method number 6 position against our existing Foot Locker trade? Well, as we saw before, let's go ahead now. I'm sorry, folks. On July 18th, this is an actual trade. Our Fusion subscribers saw this in real time. But how we ended up changing the position is our cost basis on the stock for Foot Locker was only $55.02, $55.03. We own that November 60 put for $5.10. And on July 18th, the other day. We sold that August 60 call. This is a real trade in my Fidelity account for $1.43, and we bought the August 65 for 25 cents. This gives us a profit and loss chart now where we generate a little bit of that income. We get that heartbeat we were talking about, but because we reduced the cost with other income methods, we now have no chance to lose on this position, and we still have infinite upside profit potential. We've been in the trade since May 5th, so it's been about 60 days or so on the position, 65 days into the position. We're going up to earnings in another 30 days. We have no chance for loss. On August 18th, August 19th, earnings come out from Foot Locker and the stock gaps down to even $45 per share. We're still going to have a profit of $122. If the stock gaps up to 70, we're going to be at a price profit around $656, 10% of what we invested in the position. I could liquidate this position right now for a profit. Why is that important? The stock's at 58.63. Because of the income methods, remember, we opened this position initially at $60.60. And the original put we bought was around $5 or $6. So let's call it a cost basis of $65.70 on the initial married put play for Foot Locker. The stock's at 58.63. We're at a profit. We're nowhere near the quote-unquote break-even of the original married put. We've been able to reduce our costs in the stock by applying the different income methods based in the blueprint. We added a new riskless spread trade. See, there's no monetary requirement here for this bear call spread nested in the RadioActive Trade, because broker just looks at this as a covered call with an extra long call. I take in that same credit we saw, that $1.18 of net credit, to bulletproof the total position, and because of the structure of the trade, I still have infinite upside if the stock gaps up in price. Now, a question came in, says, okay, but if the stock falls, you're only making 122, why wouldn't you exit right now? Well, because I still have the put out to November, and there's other adjustments I could do to still profit on the downside, potentially. We talked about that income method number 12. I could take some of this $1.18 credit I just generated a couple days ago and put myself in a position where I still have infinite upside, and if the stock gapped down, we get kind of a W profit and loss chart. So if the stock gaps down, let's say below 53 or 52.50, I could still profit on the downside, still have infinite profit to the upside, and no chance for loss in the middle. So multiple tools, multiple ways to adjust the position based on the current market conditions, my expectation for the stock, and my personal goals going forward. Now, I couldn't run a simulation of what this would look like on that trade simulator tool at RadioActive Trading because there's no chance for loss. It wouldn't be able to calculate it. You know, worst case scenario, I make a 1.8% profit when I'm right, or I'm wrong, and let's say I make almost 10% when I'm right. Not every trade in my position or my portfolio, not every radioactive trade is going to be bulletproof, but this is showing how you can use the advantage of credit spreads without taking on the risk and cancel all risk on the entire trade, nesting that credit spread inside a properly structured limited risk position to have no risk going into earnings, still have potential infinite upside. Now, I'm not going to find the stock that goes to infinity. I don't know if you are either as well. But if you do ever find that stock that goes to infinity, please let me know. I'd like to join it with you. Tom asked a question. Can you buy a longer term call instead of buying the underlying, buying a leap call? No. You can, but it's not going to give you the proper structure, Tom. Okay? What did we learn earlier in this presentation about the advantage of credit spreads? We look at that high leverage return of 19 or even 30% on the position, but that also incorporates leverage loss. I could say, well, instead of buying the structure here, what if I bought a November 60 call for only 12 cents? It wouldn't be priced there, but would the profit and loss chart look the same, Tom? That's what you're asking. Okay, well, let's take a look. Let's say I bought the November 60 call for 12 cents. Why am I using 12 cents? Because that was the risk I had on the married put after making all of the adjustments on the position. Okay? So this is now a different structure, isn't it? It's not the same structure that we're seeing. We have a November 60 call. We still have, oh, jeez, I took the wrong one out. Let's do that right, shall we? My apologies. That's why it didn't look right. Let's add that 62.5 call in for a bear call spread. We're going to buy that at 25 cents. That'll look better, Tom. Okay? So is this a similar structure? Absolutely. Is it a similar risk in the sense of what we could lose? That's true. But here's the problem, Tom. Remember, if I open it right now, that November 60 call, it's 285, let's call it. Of course, we're not bulletproof. I've got the same monetary risk of 167. This monetary risk of 167 using the long call, Tom, is the same I'd have if I had bought the stock today at 58.55 and bought the November 60 put. Okay? I'd have a monetary risk of 167, and this would be my profit and loss chart. But that would only be 4% of what I invested. You're still risking 100% of what you invested in the position. Here we are at the lie of leverage once again. And unless you're disciplined, sure, we might have the same monetary risk. That's assuming that you only bought one contract to my maybe 100 shares of Foot Locker and the November 60 put, okay? But let's say that we have the same account, Tom. Let's say we have roughly $40,000 trading account. We've got maybe $10,000 of free capital to enter into a position. I trade radioactively because I know the benefits of this and why over credit spreads, which I've traded for over a year and a half in my portfolio, over calendar spreads, which I traded for over a year in my portfolio, covered calls, which I traded for almost 2 years. Why am I still using 50 to 60% of this? And it's simply because putting the market odds in your favor and knowing that I might have that same risk of 167, but that's only 4% of what I invested in the position. So let's say that you saw me open this trade today, as is. I bought Foot Locker at 58.55. I bought a November 60 put, and you try to mimic that by buying the 60 call instead and doing the bear call spread on top of it, we'll have a similar risk-reward profile. But would you only buy one contract of that November 60 call? Remember, we've got $40,000 account. We've got $10,000 of free capital. I used 6,000 of that to enter this position, so I can only do 100 shares. So I'm only risking $167, or about way less than 1%, about 0.5% of my total portfolio value. Are you only going to buy one call, sell one call, and buy another? Now, I know traders, I know investors, and there's nothing, I'm not trying to scold you, Tom, but you're probably going to buy 5 contracts, maybe even 10. But let's say you buy 5 contracts, which means now you're risking $800. Well, that doesn't sound like a lot, but you're risking 100%. And that's 2 to 3% of your total portfolio value, 5 times what I'm risking in the married put. And now, with the remaining $10,000 you have in your account, you're going to buy maybe 5 calls on stock XYZ, 5 calls on stock 1, 2, 3, and so forth. Now you're going to be risking much more of that $10,000 in the open market during earnings season. If all the stocks are poor and gap down, you could lose close to 80% of what you invested in all those calls very quickly. This, again, is the lie of leverage. I don't know if you saw it, Tom, but I sent an email out yesterday referencing a archived webinar that I wanted people to take a look at, which we called Trade Comparisons. And what the trade comparison showed is the exact same thoughts I had 8 years ago when Kurt Frankenberg introduced me to radioactive trading. I have been trading for about 6 years. And I looked at it and I said, yeah, why would I buy the stock and buy the put? Wouldn't I do better if I bought the protective put and sold a near-term put, kind of like a naked put or a calendar put spread, to get into position at a better price? Why buy the stock? Why not buy an in-the-money call and buy the same put I would buy and have an in-the-money long strangle? Wouldn't I do better? Or, yeah, the married put risk-reward profile looks like this. Why don't I just buy the out-of-the-money call instead of buying it, won't I do better? Well, the webinar that was archived there, which I gave everyone a link to in the email on Tuesday afternoon, showed why all three of these do not work and do not outperform the radioactive trading position. You're asking the exact right questions. These are the same questions I asked when I was first introduced to it, and I traded this way and this way and this way for about 5 or 6 months in comparison to opening radioactive trades. And what I found is I would have done better in all three strategies by just using the married put to begin with, and that includes stocks that moved up, stocks that moved down, and stocks that stagnated. The radioactive trade, the stock plus put combination, outperformed these other potential setups to get into the position. All right? So if you still have that email, Tom, from yesterday, if you didn't watch that webinar, go back in. I'm going to be honest with you, fast forward for the first 20 minutes or so of that webinar on YouTube where we introduce the radioactive trade and kind of go over the concepts we already did in the beginning of this webinar and jump right in there to start looking at the 3 trade comparisons against the radioactive trade and why they don't work. Okay? You're asking the right questions. Don't get me wrong. All right? Okay. Joe says, what webinar was on Tuesday? Joe, I'll send you the email separately with the link to the YouTube video. It was actually from a year ago on our YouTube channel. It was the Power Options YouTube channel. It was called Radioactive Trade Entry and Trade Comparison. But I'll send you the link for that, Joe, after the webinar today. All right. So I'm going to show one more thing now. I got to do a fair comparison here, don't we? We've got to take a look at something else. Let's go back to radioactive trading. I'm going to go ahead and pause the screen for a moment. I'm actually going to log on to my account to show 2 things, okay? Now, we showed a bulletproof trade. We showed how to properly enter into a limited risk position. We showed how you could use a nested spread trade as well. Richard, yes, I'm sorry, I just saw your email. I'll go ahead and send you the link to that as well. You guys should have received an email yesterday in regards to it, but that's no problem. I'll send you the link there also about the trade comparison. And remember, fast forward for the first 20 to 25 minutes or so. All right. Okay, so I want to go to the track record real quick. Okay, this will show me the track record here at Radioactive Trading for Ernie's portfolio, my portfolio, and Greg's. Let's see here. These are my actual trades from 2008. Okay, let's see. I'm sorry, Joe and Richard. Hold on one second here. And I'm also going to do something else here in just a moment too. Okay, just give me 1 second. All right. So we talked about having more wins and losses. We talked about credit spreads and how you needed to be right. Let me try to do something here so I get this a better view. Is that any better? See if it catches up. It's a little bit better. Okay. All right. All right, so here's my actual track record. You see the wins and losses here over time. I had 3 losses recently and 5 wins. But over the course of since 2008, I've been right only 60% of the time in my radioactive trades, okay, and been wrong 40% of the time. When I'm right, I average 7.1% on my winners. My average loss is 4.7% on the losers. Okay, and this is actually taking that trade simulator tool and putting in. But let's take that into account. Let's not use bulletproofing. I'm bulletproof on 2 trades right now, essentially. But let's not talk about that. Because a simulation, if I'm never wrong and I'm always right, I can't calculate that. I have a negative risk when I'm wrong, which means a positive gain, guaranteed a profit like we just saw in Foot Locker. But let's go back to that resources tab now. And let's take a look at those numbers. Their actual trading record. So let's say that when we were right, we win 7.1%. Much lower of return than we can get with a credit spread, right? But at the same time, the one thing radioactive trading gives us that we can't control in a credit spread or on a long call or on a calendar spread is that I can guarantee that I'm only risking 4.1% or 4.7% when I'm wrong, okay? Now, I was right 60% of the time, so my probability of loss is only 40%. How would that perform? Well, see here, even with 2 losses right off the bat, the first 3 trades, I have 2 losers and 1 winner. And I take the account down by about 2%. That's the maximum drawdown. And over time, because we skewed the market odds in our favor, can I control what return I'm going to make on any position that I'm open? No. You know what the max profit is on your credit spreads or your covered calls. That's true. Do you know that you have management techniques to try to improve that or try to limit losses when stocks go against you? Well, I've got 12 different income methods I can use to control this risk, lower the risk that I initially set up with, okay? But I can't control the return that I make. I can't control how I'm going to win or lose. The market's going to dictate that. This is just what has happened in my portfolio. The only thing I can control in the market is how much I'm willing to risk. And by controlling the risk to single digits, we'll outperform other strategies, even with a lower target return. Here's a fascinating thing about this. You see this, I'm right 7.1% of the time. I'm only lose 4.7% when I'm wrong. I'm sorry, my target return is 7%. Let's change our probability. Let's put it right at 50-50. Look at that. This is the only strategy I know of, and my goal is not to do this, but this is the only strategy I know of where you can be wrong more often than right because you're controlling the risk, the only thing you can control in the market. I can be wrong more often than right and still make money in this simulation. It's almost a 30% return, and I'm only right 46% of the time, and I'm wrong 54% of the time. Okay, let's try to get to 50-50 even. Well, there's 52. You see we've got a high return there. Low drawdown 54. There we go, 50-50. Half the time I'm right, half the time when I'm wrong. Make 7% when I'm right. Only lose 4% when I'm wrong. Be right half the time. And would still profit long term. Okay, that's the only strategy. This is the only strategy I know of. So to answer that other question come in, why are you allocating 50 to 60% of your portfolio into radioactive trading? My goal is not to be wrong more often than right, but I can't control that. The market dictates that. But using the techniques, the proper setup to skew the market odds in my favor that we talk about in the blueprint, and having the ability to use 12 different income methods for if the stock moves up, if the stock stagnates, or if the stocks move down in price, then I can put myself in a position to control losses even more and still receive a good target return. John says, percent invested per trade. Sure, I could drop this down. Let's say I was trading with a $20 or $10,000 account. I only invested 20% per trade. Well, there's 60-40. Yeah, there's 49-51. So we don't get as much gain on the winners, but we see much less loss on the losers as well. Still profitable, being wrong more often than right. And absolutely, this is one of the core principles I mentioned for radioactive trading is proper position sizing. In the first few chapters of the blueprint, we talk about not just what the setups you're looking for, but what is a proper position size trade. How much should you risk in each position? How much should you look to invest in your portfolio in each position as well? So we talk about the proper position sizing as well as proper portfolio sizing also. Okay? But you guys can play around with this. You just go to radioactivetrading.com, click on the resources tab, and you can put in your numbers for your expected target, what maybe you're setting your stop losses at, and your success rate, and see what you could expect to perform over time. Again, we know how that's going to potentially turn out because we already asked this earlier. 20% of you are doing great. You've got more winners than losers and you're ahead. But think about this. For those of you that are trading great right now, I'd love to see that. If you controlled your losses on those positions that you had that went against you, but if you only lost 4, 5, or 6% on that losers, would that have made you do even better? 67% of you win some, lose some, but you're not seeing the returns that you want? Okay, well, we just showed you how you can even be wrong more often than right and still make money. 5% we had winning more than they lost, but they still lost money. And we saw why when we looked at the structure of the credit spreads, the attractiveness of credit spreads, and that great high probability in this 19%, 11% leverage return comes with that leverage percent risk. And for the 10% of you that are unfortunately losing money and you're way behind, well, you can choose now to get out of the game and stop. You can choose now to maybe get a little bit more educated, or you can choose to get a little bit more educated now by controlling your risk properly so those losers you have will not get too far away from you. It will not go too far beyond to where you suffer those losses now, okay? Oh, Tom says your account is 60,000 now. What did you start with? That's not I didn't start with 10,000. I started with much less than that. This is a simulation. Oh, sorry, folks, I'm in the wrong place. Let me go back to track record. There you go. Okay, let me show you this real quick. The simulation, Tom, what it's showing you is if over 100 trades, I keep the same win-loss ratio and winning 7% when I'm right and 4.7% when I'm wrong, I could potentially, well, refresh it. Let me refresh it back there. It could potentially go up to 60% or 60,000. Oh, shoot. Thank you. Thank you, thank you. Aha, much better. All right, so there we are. We're back now. Okay. But here's the trick. I started with when Kurt first introduced me, I allocated close to about 7,500, I think, to radioactive trading. Okay? And I'm trading right now, but it's not all radioactive trading. My account size that I'm allocating to options trading is around 42,000 right now. Okay, but that's not all from radioactive trading. I've put money in. Okay, I've added money into the account. But this simulation is showing you, and I only have 45 trades, Tom. I'm not at 100 total radioactive trades. About 10 trades per year, you know, or a little bit less than that. 9, 10 trades per year is what it comes out to roughly when I started allocating more money into it in 2009 and then 2010, okay? So this is what's possible. If I did trade 100 trades, made 7% on average when I'm right, only lost 4.7% when I'm wrong, and I was right, I keep that at 60% of the time, this is what the simulation would show to, okay? And in the simulation, I'm not putting in commissions, but I'm also not putting in dividends, all right? So that's the expectation there. Is my account at 60,000? No, but it has increased year over year since I've been trading radioactively from profits I've made on other positions, from adding more money, I should say allocating more money to radioactive trading, because long term, this has been more successful for my trading than I was in I apologize, folks, than I did with calendar spreads. I'll be honest, calendar calls, calendar puts was the most successful strategy monetarily and percentage-wise I've ever traded in options for about an 8-month period. The 4 months following that, I suffered the largest losses monetarily and percentage-wise than I have ever suffered with any other option strategy, okay, as well. Let's see, William asked, why are you not trading all radioactive? Because I like to do some other things. The story I just told you, William, about calendar spreads, I'm a glutton for punishment. I keep going back. For some reason, my mind just likes calendar spreads. I like the idea of, you know, trying to analyze theoretically, what is that long call going to be worth? I don't know. You don't know. It's not etched in stone. You know, I'd enter a calendar spread with a 5-month out call, and I sell a 2-week out call against it. And I say, okay, if the stock's trading here, my call might be here, it might not be. If implied volatility increases, I can do better than is projected. I like playing around with it, okay? So about 5 to 10% of my account is still allocated to that. I'm a fan of standard collars. I've been trading those since roughly 2002. After my first year and a half or so of trading covered calls, I guess it was, I realized the problem and I started doing standard collars, which applies some of the technique here of radioactive trading, but again, it caps the upside. But for positions that have a great premium that I'm not long-term bullish on, I'll open as a standard collar. Still only have a 4% risk with a potential of maybe a 2.5–3% return for a 2, 3, 4-week trade. I like those as well. And I still trade maybe 10 to 15% of my allocated capital to options on credit spreads that I, you know, showed why they don't work. But I trade credit spreads only on the broad-based indexes and ETFs rather than on stocks. Okay, so a little bit of income here, a little bit of income there, trading the markets. That 10% I mentioned or so that I use for calendar spreads, I've actually taken that off the table right now because I'm doing some long straddles and long strangles on stocks that have earnings coming up. Okay, all right. Well, if anyone has any last minute questions, go ahead and send those in. Want to just share with everyone here was oh, a dynamic collar? Yeah, I do those. I don't call them, I kind of call them dynamic collars, but yeah, I kind of do those as well. John says, still having problems selecting good RPM candidates. Any thoughts or advice? Well, one thought, John, you can schedule a coaching session, of course, or call us up at the office. I'm not going to be available for the next hour or so. We can go over it. Again, you can send me an email with some of the things that you're using as a blueprint owner, as a radioactive trader. You can send me an email at any time with what you're kind of looking at, what's been working, what hasn't been working, and we can take a look at that as well. I'm actually might open 1 or 2 new positions coming up for radioactive trading for Fusion subscribers as well, but we'll let you know what those are as well. All right, so I just wanted to tell everyone here, the only place where we discuss all 12 income methods, the initial position is in the blueprint. You can go to radioactivetrading.com/iridium, and you can see the 5 bonuses that we're offering right now for the blueprint. In addition to getting the full technique and the 12 different income methods, we'll send you what Kurt calls the Quick Action Guide. It's designed to help you start trading radioactively faster. We'll also send you one of his 6 Mastery Series CDs, the Fort's Foundations of Radioactive Trading CD as well. We'll get that to you as part of the bonuses if you pick up the blueprint. And just go to radioactivetrading.com/iridium, and I sent that link to everyone there in the chat box. You get your first month of Fusion for only $10. So investors who pick up the blueprint get that first month of Fusion for only $10. And you also get a free month of Power Options, the tools we showed today. In addition to that, you can schedule one of the free coaching sessions that I mentioned. We'll walk you through the tools on the site and answer your questions about radioactive trading concepts. And in addition to that, if you pick up the blueprint, you also have a money-back guarantee. Okay? If you're not satisfied with the content in the blueprint, then go ahead and if you feel it's not going to help your portfolio, you can send it back to us. We'll refund your purchase price as well. All right, so let's see here. Okay, Tom says, unfortunately, I have joined a weekly credit spread advisory that typically risks about $200 to $300 to bring in 10. Yeah, that's that 20 to 1, 15 to 1 risk reward ratio. Can I use the income methods on a weekly basis to improve these trades? Not exactly, all right? The income methods in the blueprint are done in the structure of that initial proper setup to limit risk and then how to further lower that risk and bulletproof the trade like we saw with the Foot Locker position. If you have a credit spread, okay, so let's say we enter into a bull put credit spread like we saw with Foot Locker earlier. I sell the 55 put and I buy the 52.5. But let's say that net credit was 50 cents and I'm risking 200, or 10 cents even, I'm risking 200. You're looking at high probability trades in this advisory service you mentioned, Tom. What could go wrong with that bull put credit spread? Well, if the stock falls, I could lose money on the position, couldn't I? I'd have the full loss. How do I protect the bull put credit spread against the stock falling? How can I change that? Well, you'd have to buy a further out of the money put. So if the stock fell, you'd gain on that put to counter the loss in the bull put spread. What's the problem? The minute you do that, which we would consider maybe income method number 12 on top of our radioactive trade, you no longer have a credit spread. In fact, the only way you'd profit is if the stock fell. You've now taken a bullish bull put spread, tried to protect it, but created a bearish position on a stock that you're bullish on, and you would no longer have the net credit. Trying to cancel the risk on a credit spread usually means you're canceling the credit and you're changing the direction of the strategy. Steve asks, I got the blueprint years ago. Is a supplement available to get new income methods? Absolutely. When you bought the blueprint, you would have received a free registration account. You would have received a password where you can log on to radioactive trading as a blueprint owner. And what you'll be able to do is you'll be able to click on a link that says latest blueprint revisions, and you'll be able to download all of the updates, all of the new income methods that came out, and all of the updates to the blueprint, print them out and plug them right into you. Okay, so blueprint owners always get those updates to the position, always get the updates to the new additions available. You can log on your free registration account, Steve, and access them at any time. Okay, I'll do one more thing real quick for those of you that stayed online. I know some of you have left. Oops, sorry folks. I'm just going to go, for those of you that asked that are still online here, I'm going to send you all of you that requested it, I'm going to send you the email for that link to what we talked about with the trade comparison, but I'm just going to look it up very quickly right now for you all. Let's go here. Just give me 1 second. I'm just going to pull that up here on our account. There we go. Okay. All right. Oh, sorry, folks. Just got to find the right one. There it is. Okay, bear with me 1 second, and here we go. Okay. Yep. Don't start playing. There we go. Okay. So for those of you that are still online that asked for it, I just sent you all the link as well. You've got the radioactivetrading.com/iridium. You can see that there to pick up the blueprints and the 12 different income methods. And then that link I sent you to the YouTube video is the one where we discuss the trade comparisons that we talked about for some of you as well. Okay. Oh, Tom asked, had a question about the paid webinar. The CD Stop Losing at Credit Spreads, one of the other products we have. Is that mailed out or is it just on demand? It's just on demand. If you order the one of those webinars for the Stop Losing at Credit Spreads Forever, what happens if the market goes haywire, and I think ways to position for profit even if the stock goes down, we will send you a link where you can access that recording at any time, but it's not sent out as a hard copy. Okay, and if you don't have that link anymore, just give me a call, send us an email, and let me know, and we'll get that set up for you. All right. Well, that's all I have for today. I don't see any other questions. So if you think of any questions later on, remember you can send us an email at any time to support@radioactivetrading.com. You can also call us at any time at 302-992-7971. So thank you all for joining me today. I did record today's presentation. We'll post it in the archives at radioactivetrading.com probably around 5 p.m. Eastern Time. And I'll scroll through the questions there, and I'll get everyone who asked that for that YouTube link there. I'll send you that for the video on the trade comparisons as well. So have a good night, everyone. Take care. We'll talk to you soon. Happy trading.